The stock market is one of the most powerful financial systems ever created, and it plays a major role in shaping economies, businesses, and individual futures. In the United States and many developed countries, the stock market is not treated as gambling or speculation, but as a structured financial system designed to help companies raise capital and allow individuals to participate in economic growth. Educational finance channels explain the stock market not as a shortcut to wealth, but as a long-term mechanism that rewards patience, discipline, and informed decision-making. At its core, the stock market connects two groups: businesses that need money to grow, and investors who want their money to grow over time. This connection is what makes the stock market such an important topic in finance education. A documentary-style explanation focuses on how the system evolved, how it functions today, and why it remains central to modern capitalism. Rather than focusing on daily price movements, educational content explains the purpose of the market, its structure, and its long-term impact on wealth creation. Understanding this foundation is essential before discussing individual stocks, penny stocks, or emerging trends like artificial intelligence investing. To understand how the stock market works, it is important to understand why companies issue stocks in the first place. When a company wants to expand operations, build new factories, invest in research, or enter new markets, it needs capital. Instead of borrowing money from banks and paying interest, many companies choose to sell ownership shares to the public. These shares represent partial ownership in the business. When people buy these shares, they are not just buying a price on a screen, they are buying a claim on the company's future earnings and growth. Educational finance documentaries explain this process as a partnership between companies and investors. The company receives capital, while investors gain the potential to benefit if the company succeeds. This is why stock market investing is fundamentally different from short-term speculation. Over time, successful companies increase revenues, expand market share, and improve efficiency. When that happens, the value of ownership in those companies tends to rise. This long-term relationship between business growth and shareholder value is the foundation of stock market education. The stock market itself functions as an organized marketplace where shares are bought and sold. In the United States, this happens through regulated exchanges where prices are determined transparently through supply and demand. Educational finance content emphasizes that prices move not randomly, but based on information. Earnings reports, economic data, interest rate decisions, and global events all influence how investors value companies. When investors believe a company's future is strong, demand for its shares increases. When confidence declines, prices fall. This constant reassessment of value is what gives the market its dynamic nature. Documentary-style explanations focus on how this process reflects collective expectations about the future. The market is not predicting tomorrow, but constantly adjusting based on new information. Understanding this helps beginners avoid emotional reactions to daily fluctuations. Instead of seeing volatility as chaos, educated investors see it as part of a system that processes information at scale. This perspective is critical before moving into more complex topics like small-cap stocks, penny stocks, or high-growth sectors such as artificial intelligence. One of the most important distinctions in stock market education is the difference between trading and investing. Trading focuses on short-term price movements, often driven by technical patterns and market sentiment. Investing, on the other hand, focuses on long-term business performance and fundamentals. Educational finance channels typically emphasize investing because it aligns with wealth building over time, rather than short-term speculation. Documentary-style finance content explains that most long-term market wealth has been created by investors who held quality businesses through multiple market cycles. These investors were not reacting to every headline, but focused on the underlying strength of the companies they owned. This distinction becomes especially important when discussing penny stocks or trending sectors. Without a clear understanding of investing versus trading, beginners can easily confuse speculation with education. A responsible finance documentary makes this difference clear and encourages viewers to understand risk before participating in the market. Long-term investing works because businesses tend to grow alongside the economy. As populations increase, technology advances, and productivity improves, many companies expand their revenues and profits over time. Educational finance documentaries explain that stock returns are closely linked to this economic growth. While markets experience recessions and downturns, history shows that diversified markets have recovered and moved higher over long periods. This is why time is one of the most important factors in investing. The longer money remains invested, the more opportunity it has to benefit from compounding. Compounding occurs when returns generate additional returns, creating exponential growth over time. This concept is central to finance education because it explains why consistency often matters more than timing. Understanding compounding also helps explain why starting early can have a greater impact than investing large amounts later. Risk is an unavoidable part of the stock market, and educational finance content treats risk as something to be managed, not avoided entirely. Different stocks carry different levels of risk depending on company size, financial stability, and industry conditions. Large, established companies tend to be more stable, while smaller companies often experience greater volatility. Documentary-style explanations emphasize that risk and reward are linked. Higher potential returns usually come with higher uncertainty. This concept is essential when discussing penny stocks, which are often small companies with limited operating history. Without proper context, beginners may underestimate the risks involved. The Finance Education channel explains that understanding risk allows investors to make informed decisions rather than emotional ones. Diversification is one of the most important tools for managing risk in the stock market. This concept becomes especially relevant when discussing emerging sectors like artificial intelligence, where uncertainty is high. While some companies may become industry leaders, others may fail. Market cycles are another key topic in stock market education. Understanding market cycles helps investors avoid panic during downturns and excessive optimism during booms. This mindset is particularly important when evaluating high-risk areas like penny stocks, where cycles can be more extreme. Stock market indices play a major role in understanding overall market performance. Indices represent groups of companies and provide a snapshot of market trends. Educational finance documentaries explain indices as benchmarks rather than investment recommendations. When indices rise, it generally reflects positive economic expectations. When they fall, it signals caution. Understanding indices helps beginners interpret news, headlines, and market movements in context rather than reacting emotionally. Market capitalization is another fundamental concept in stock market education. It refers to the total value of a company's outstanding shares and helps classify companies as large cap, mid cap, or small cap. Educational finance content explains that company size affects risk, stability, and growth potential. Large cap companies are often leaders in established industries, while small cap companies may offer higher growth but greater uncertainty. Penny stocks typically fall into the small cap or micro cap category, which is why they require careful analysis. Penny stocks are generally defined as stocks trading at very low prices, often under a few dollars. Educational finance documentaries explain that price alone does not determine quality. A low-priced stock is not necessarily cheap, and a high-priced stock is not necessarily expensive. Penny stocks are usually associated with smaller companies that may lack consistent revenue or profitability. This makes them more speculative. Finance education channels present penny stocks as a category that requires higher scrutiny, not excitement. The appeal of penny stocks often comes from the perception of high upside. A small price increase can appear dramatic in percentage terms. Educational content explains that this perception can be misleading. High volatility means prices can move down just as quickly. Documentary-style explanations focus on understanding business fundamentals rather than price alone. This helps viewers separate realistic opportunities from unrealistic expectations. Artificial intelligence has become one of the most discussed themes in modern investing. Educational finance documentaries explain AI as a transformative technology that impacts multiple industries, including healthcare, finance, and transportation. AI investing is not a single trend, but a broad category that includes software, hardware, and data companies. Understanding this complexity is essential before discussing AI-related stocks. AI penny stocks represent a subset of the AI investment space. These are small companies attempting to apply artificial intelligence to niche problems. Educational finance channels explain that while some of these companies may succeed, many are still in early development stages. Revenue may be limited and profitability uncertain. This makes AI penny stocks highly speculative. A documentary-style approach emphasizes evaluation rather than promotion. When explaining AI penny stocks, educational content focuses on real factors such as business models, partnerships, and technology adoption. Instead of predictions, finance documentaries explain how investors analyze early-stage companies. This approach helps viewers understand process rather than chasing hype. AI is a powerful trend, but not every company associated with AI will succeed. Another important concept in stock market education is liquidity. Liquidity refers to how easily a stock can be bought or sold without affecting its price. Penny stocks often have lower liquidity, which increases risk. Educational finance documentaries explain why liquidity matters and how it impacts price volatility. This understanding helps beginners avoid unexpected losses. Regulation is also a critical topic in finance education. Stock markets operate under regulatory frameworks designed to protect investors and ensure transparency. Educational documentaries explain how regulations vary by market and why compliance matters. Penny stocks may sometimes trade in less regulated environments, increasing risk. Emotions play a significant role in investing decisions. Educational finance channels explain how fear and greed influence market behavior. Documentary-style content helps viewers recognize emotional patterns and develop discipline. This psychological aspect is often more important than technical knowledge. Financial statements are essential tools for understanding companies. Educational finance documentaries explain income statements, balance sheets, and cash flow statements in simple terms. This knowledge is especially important when analyzing small or emerging companies. Economic indicators provide context for market movements. Educational content explains how inflation, interest rates, and employment data affect stock prices. Understanding the economy helps investors interpret trends more accurately. Technology has transformed access to the stock market. Educational finance documentaries explain how digital platforms have democratized investing while also increasing information overload. This makes education more important than ever. Responsible finance education avoids making promises. Documentary-style content emphasizes probabilities, not guarantees. This approach builds long-term trust with viewers. The stock market should be viewed as a tool, not a shortcut. Education helps investors approach these areas with realism rather than excitement. In conclusion, the stock market is best understood through an educational, documentary-style lens. This approach empowers viewers to make informed decisions and build financial literacy over time.